this computer. Let me see, yes. Okay, so I think it's, yeah. Okay, recording is started now. Okay, so disability, we're talking about sources of income protection. So one is person can have an individual disability insurance, right? That's one way they can have the coverage, right?
Yes.
They can have it through their own disability policy. Second is through the group disability,
Yes.
which is through employer or professional association. So it's not necessarily, doesn't have to be working. It can also be like professional association, like a group of alumni or people who are all working or who are of the same like profession. They can also be a group, right? And
Yes.
then the third one is creditor disability through the banks and the lending institutions. So the banks, they offer these type of, like, if you become disabled, then your mortgage payments are going to be covered, right? So this is through the banks and lending. So they have mortgage disability insurance, and they have for line of credit. So usually it will just pay the minimum payments for the mortgage or the minimum payment for the line of credit. But in some cases it may pay off the total amount, but that depends on the policy, right? So with the mortgage insurance, usually it is selected by the lender. The beneficiary is the lender, that is the bank, because the bank is going to get their loan paid off if the person becomes, sick, cannot work. And in the case of individually, the benefit is that the money comes to the individual, and the individual can use the money as they want for their expenses. So of course the mortgage insurance rates are lower, but this is higher, but it is better for the client because they are able to get more better coverage that way. Yes. So these are three types of income protection. Those are possible.
Yes.
Okay. Sure. Then, so these are the different types of accident sickness policies. So these first three here in the column, so you have non-cancelable, guaranteed renewable, and cancelable, yes. Right? These are the three main types. The guaranteed issue are the ones which are under group insurance only, right? Mm-hmm. Under the individual policies, these are the three types. So non-cancelable means that the insurer cannot cancel the policy. So think of it like, the person who has got the disability insurance, they can cancel anytime. If they stop payment for 1 month, the policy will be canceled, right? Mm-hmm. So this is for the insurer, that the insurer cannot cancel it, like the life insurance company. Yes. Premium, the company cannot increase the premium. The company cannot reduce the benefits. They cannot say you had 4,000, now we're only going to pay you 3,000. And the insurer must renew the policy annually. Okay. Yes. So this is the conditions for the non-can. It's a good policy. Of course, it's the best policy. It is more expensive, but it is the one which mainly the professionals and the more, executive people, they will buy the non-cancelable policy. Yes. And the definition of disability is own occupation. In the next slide, we'll talk more detail about it, but own occupation means that even if the person is working so if the person cannot do their own occupation and they work in any other job, they still will get the payment for the disability. So that is own occupation, right? So that is the own occupation. And so this is non-cancelable. Under the guaranteed renewable, we have that the insurer cannot cancel the policy, and they can increase the premium for the same class or work group after 30 days written notice. So if they give 30 days notice, then they can increase the premium, but it has to be for the same group of people. For example, they can say, all the taxi drivers, we are increasing your premium. Yes. Or all the, one group of people of work, they can have their policy premium increased. They cannot increase for one person. So they can also change the benefits, again, for the same class or group after 30 days notice. But still, they cannot cancel the policy at any time. That is why it is called guaranteed renewable, because they cannot still cancel it. And here, the definition of disability is any occupation. So if the disabled person can work in any occupation for which they are suited, then they cannot get the disability payment. So it's more difficult to claim in this type of guaranteed renewable.
For example, when the person can work in lower level or something else, they cannot apply for the policy?
So if they can work in the lower one, it depends on if they have option of partial disability. If they can work part-time, then they may get a partial payment. But if they are working in a lower type of product policy type of work, then it's in any occupation, then their benefits may be stopped or they may get less payment.
Less payment. Okay.
Yes. Only in own occupation, they will get the full payment.
Okay.
Cancelable one is this is of course cheapest one, and is not good, of course, but it is more for the high risk ones like the taxi drivers or the truck drivers. They may get this one, which is insurer can cancel anytime with 30 days notice. They can increase the premium for the group. They can change the policy benefit, and the company can cancel it anytime. So this is a cancelable type. And here again, we have any occupation is the definition here. Okay, and then, so the group one, this one here is for the, in here, the insurer cannot cancel the policy. And the restriction is usually size of the group. That is the main, thing, depending on the, what is the size of the group, right?
Yes.
And the occupational class, so they look at overall, what is the risk of the group of people, if they are executives or they have risky type of work where they can get injured. There's a minimum annual premium and there's a minimum average age for the group. Usually they want the group to be older than certain age. So in the group one, the life insurance people, they cannot increase the premium. It cannot be reduced or modified. The insurer must renew the policy annually. And the disability definition is own occupation here also. So as we can see in the case of the group one, it is own occupation. So it is like a good policy, and they cannot increase the premium, right? And they must renew the policy annually. So this is called a guaranteed issue. Here, of course, they don't do any checking of the, of the health or anything.
Yes.
Right. So is that clear? These three,
yes,
these four
yes.
types.
Yes.
Good. Okay. So the policy benefits, when you're making the policy for the client, you have to decide several things. First, you have to decide what is the amount of benefit they will get, how much money they want. And the DI policies, they pay tax-free disability amount. So the money that they get, they don't get taxed on it. So usually, regularly, it is like 60% of pre-tax income. So if the salary is 80,000, so we calculate, 60% of that, right? So 80,000 on your calculator, you can do times 60%, right? And that will give you $48,000. So that is the, 60% will be how much they'll be covered. If you divide it by 12, they'll be $4,000 monthly. Okay.
Yes.
Here. So for self-employed, the way to calculate is the business income minus the expenses. So the net income is used to calculate the 60%. So in this case, if 70,000 is the business income, we minus the $12,000 expenses. So we get $58,000, and then 60% of that will be $34,800.
Yes, I understand.
So that will be the calculation for self-employed. And if the person has unearned income, it reduces the DI benefit. So if the person has $20,000 trust income, so if they have investments and they're getting regular income from it, so then the way to calculate that is we take $70,000 and we minus the expenses from it. So same way as we did here, we end up with $58,000. But now we add the trust income to it. So when we add the trust income, we come up with 78,000. Okay, so 78,000, and then we take 60% of that, which will result in 46,800. Right. So this is what we do here. But then we again, when we take the 46,800, the client cannot get that money. We have to minus the 20,000 trust income. So the client can get 26,800.
So if he get 20,000 from the trust, it will be cut it from the benefit.
Yes, because it will reduce the benefits, right?
Yes.
Okay.
Okay.
The waiting period is also known as the qualification period. So you have to decide with the client that how much time do they want to wait before the benefits start. So that is the waiting period when there's no payments from the disability. It could be 0 days, so then payments start right away, or 30 days, or 60 days. 90 days is more common. So 30 days is more common, or 1 year. So this is the like waiting period. So longer waiting period, if you want to lower the premium, so the longer the waiting period you put, the less the premium for the client.
These numbers also come into the exam. If in exam they ask me the number, how long, so the waiting time is, which one should I mention? 0, 30, 60, or 90?
It depends on the client. There's no right answer about how much time, but the question they can ask you is the person wants to have a low premium. They want to have a low premium. So they can give you, oh, they want waiting period of 0 days, 30 days, or 60 days, or 90 days. So if they want lower premium, then 90 days would be the right answer.
Yes, okay.
Right? So that way you have to know that that is the concept, right? That they will wait 3 months, no payment, then the payment start, so the premium will be lower that way.
Because I was confused during reading, sometimes it was 30 days, sometimes 60 days or 90 days, and I didn't know which one I should answer in the exam.
Yes, so you have to see, usually they want to know what is, which one will give the lower premium, and the longest days, the more time will have the lowest premium.
Yes, okay.
Okay, all right, good. So now the benefit period, so the period of the benefit can be for how long they're going to get the payments. If they're going to get $3,000, $4,000 monthly, is it going to be for 2 years, or 5 years, or 10 years, or 65 age, right? And keep in mind, no disability policy pays after age 65, because at that time the person is considered, they will have retired, right?
Yes.
So after retirement, no more disability payment. So they may ask, like, how can they hear also, how can they reduce the premium? So the longer the benefit period, the higher the premium. Here you want to get less time period will give you less premium, right? So if they get benefits only for 2 years, it's a lower premium. 5 years is more premium, 10 is more premium.
Of course.
Right?
Yes.
Here. So this also you need to keep in mind how to reduce the premium. Okay. And then the and then the exclusion limitation. So sometimes the client may already have some trouble, like some back pain or some other issues. So based on that, you need to see that overall, if there is any, well, this is like underwriting, they will do that. They will look and see, but
yes,
the client needs to disclose if they have had disability before, if they have a back issue, if they have other issues, right? So the client has to indicate it. And there may be exclusions there. And then of course, client will not be covered if they go and fight a war or they do terrorist activity,
yes,
if they get injured and self-inflicted, they do something to themselves, if they do attempted suicide, illegal activities, normal pregnancy, delivery, these are not covered. And if the client has already back issues or something, underwriting department will either, they can say, okay, if you become disabled because of your back, you will get only $3,000 a month. Everything else will be $4,000 a month. So they can do that. That is like a limitation, right? Or they can reduce the length of the benefit. They can say, if you become disabled for any reason, you're covered for 5 years. But if you are disabled for back pain because you had back before problem, it's only going to be covered for 2 years. So they can reduce the length of the benefit. Or they can increase the length of the waiting period. they can say that if you become disabled because of your back, no payments till 90 days, everything else will be 30 days.
Mm-hmm.
So
Okay.
these are things they can do to manage the payments, right? Clear? Okay, and then so they may deny the claim if the client has, doesn't give the right information. They may say that, your information is not clear, so we cannot give you any benefit. There may be fraud, there may be absence of loss if the client does not have any, loss in their income, or the client does not give proof that they got disabled, doctor report is not provided, or they delay filing the claim. So based on that, then they may deny the claim.
Yes.
Rehabilitation